A Random Walk Down Wall Street, Disc 5.
Perhaps the most colorful investment gurus of the mid-1990s were the homespun, grandmotherly, median-age 70 Beardstown ladies. Called by publicists the greatest investment minds of our generation, these celebrity grannies cooked up profits and hype, selling more than 1 million books and appearing frequently on national television shows and in weekly magazines. They mixed explanations of their investment success, heartland virtues of hard work and church-going, with yummy cooking recipes, such as stock market muffins, guaranteed to rise. In their best-selling 1995 book, The Beardstown Ladies' Common Sense Investment Guide, they claim that their investment returns were 23.9% per year over the preceding decade, far eclipsing the 14.9 annual percent return of the S&P 500 index. They suggested that ordinary folks could do just as well following their advice. What a great story. Little old Midwestern ladies using common sense could beat the pants off the overpaid investment pros of Wall Street and could even put index funds to shame. Unfortunately, the ladies were discovered to be cooking the books as well. Apparently, members of the Beardstown group were counting their investment club dues as part of their stock market profits. The accounting firm Price Waterhouse was called in, and it calculated the ladies' true investment return over the decade to be 9.1% per year, almost 6 points below the overall market. So much for getting rich by worshipping investment idols. The moral to the story is obvious. With large numbers of technicians predicting the market, there will always be some who have called the last turn or even the last few turns, but none will be consistently accurate. To paraphrase the biblical warning, he who looks back at the predictions of market gurus dies of remorse. Why are technicians still hired? It seems very clear that under scientific scrutiny, chart reading must share a pedestal with alchemy. There's been a remarkable uniformity in the conclusions of studies done on all forms of technical analysis. Not one has consistently outperformed the placebo of a buy-and-hold strategy. Technical methods cannot be used to make useful investment strategies. This is the fundamental conclusion of the random walk theory. A former colleague of mine believed that the capitalist system would weed out all useless growths, such as the flourishing technicians. The days of these modern-day soothsayers on Wall Street are numbered, he would say. Brokers will soon learn they can easily do without the technicians' services. The chartist's durability suggests that the capitalist system may garden like most of the rest of us. We like to see our best plants grow, but as summer wears on, the weeds often get the best of us. The point is, the technicians often play an important role in the greening of the brokers. Chartists recommend trades. Almost every technical system involves some degree of in and out trading. Trading generates commissions, and commissions are the lifeblood of the brokerage business. The technicians do not help produce yachts for the customers, but they do help generate the trading that provides yachts for the brokers. Until the public catches on to this bit of trickery, technicians will continue to flourish. Appraising the counterattack. As you might imagine, the random walk theory's dismissal of charting is not altogether popular among technicians. Academic proponents of the theory are greeted in some Wall Street quarters with as much enthusiasm as former Enron chairman Jeff Skilling addressing the Better Business Bureau. Technical analysts consider the theory just plain academic drivel. Let us pause, then, and appraise the counterattack by beleaguered technicians. Perhaps the most common complaint about the weakness of the random walk theory is based on a distrust of mathematics and a misconception of what the theory means. The market isn't random, the complaint goes, and no mathematician is going to convince me it is. Even so astute a commentator on the Wall Street scene as Adam Smith displays this misconception when he writes, I suspect that even if the random walkers announced a perfect mathematical proof of randomness, I would go on believing that in the long run future earnings influence present value, and that in the short run the dominant factor is the temper of the crowd. Of course, earnings and dividends influence market prices, and so does the temper of the crowd. We saw ample evidence of this in earlier chapters of the book. But even if markets were dominated during certain periods by irrational crowd behavior, the stock market might still well be approximated by a random walk. The original illustrative analogy of a random walk concerned a drunken man staggering around an empty field. He's not rational, but he's not predictable either. Moreover, new fundamental information about a company, a big mineral strike, the death of a president, etc., is also unpredictable. It will occur randomly over time. Indeed, successive appearances of news items must be random. If an item of news were not random, that is, if it were dependent on an earlier item of news, then it wouldn't be news at all. The weak form of the random walk theory says only that stock prices cannot be predicted on the basis of past stock prices. Thus, criticisms of the type quoted above are not valid. The technical analyst will also cite chapter and verse that the academic world has certainly not tested every technical scheme that has been devised. That is quite correct. No economist or mathematician, however skillful, can prove conclusively that technical methods can never work. All that can be said is that the small amount of information contained in stock market pricing patterns has not been shown to be sufficient to overcome the transaction's costs involved in acting on that information. Consequently, I have received a flood of letters condemning me for not mentioning, in my earlier editions of this book, a pet technical scheme that the writer is convinced actually works. Being somewhat incautious, I'll climb out on a limb and argue that no technical scheme whatever could work for any length of time. I suggest first that methods that people are convinced really work have not been adequately tested, and second, that even if they did work, the schemes would be bound to destroy themselves. Each year, a number of eager people visit the gambling parlors of Las Vegas and Atlantic City and examine the last several hundred numbers of the roulette wheel in search of some repeating pattern. Usually they find one, and so they stay until they lose everything because they do not retest the pattern. Edward O. Thorpe actually did find a method to win at blackjack. Thorpe wrote it all up in Beat the Dealer. Since then, casinos switched to the use of several decks of cards to make it more difficult for card counters, and, as a last resort, they banished the counters from the gaming tables. The same thing is true for technicians. If you examine past stock prices in any given period, you can almost always find some kind of system that would have worked in a given period. If enough different criteria for selecting stocks are tried, one will eventually be found that selects the best ones of that period. Let me illustrate. Suppose we examine the record of stock prices and volume over the 5-year period of 2002 through 2006 in search of technical trading rules that would have worked during that period. After the fact, it's always possible to find a technical rule that works. For example, it might be that you should have bought all stocks whose names began with the letters X or D, whose volume was at least 80,000 shares a day, and whose earnings grew at a rate of 10% or more during the preceding 5-year period. The point is that it's obviously possible to describe, after the fact, which categories of stocks had the best performance. The real problem is, of course, whether the scheme works in a different time period. What most advocates of technical analysis usually fail to do is to test their schemes with market data derived from periods other than those during which the scheme was developed. Even if the technician follows my advice, tests his scheme in many different time periods, and finds it a reliable predictor of stock prices, I still believe that technical analysis must ultimately be worthless. For the sake of argument, suppose the technician had found a reliable year-end rally. That is, every year stock prices rose between Christmas and New Year's Day. The problem is that once such a regularity is known to market participants, people will act in a way that prevents it from happening in the future. If such a regularity was known to only one individual, he would simply practice the technique until he had collected a large share of the marbles. He surely would have no incentive to share a truly useful scheme by making it available to others. Any successful technical scheme must ultimately be self-defeating. The moment I realize that prices will be higher after New Year's Day than they are before Christmas, I'll start buying before Christmas ever comes around. If people know a stock will go up tomorrow, you can be sure it will go up today. Any irregularity in the stock market that can be discovered and acted upon profitably is bound to destroy itself. This is the fundamental reason why I am convinced that no one will be successful in using technical methods to get above-average returns in the stock market. Implications for investors. The past history of stock prices cannot be used to predict the future in any meaningful way. Technical strategies are usually amusing, often comforting, but of no real value. This is the weak form of the random walk theory. Technical theories enrich only the people preparing and marketing the technical service or the brokerage firms who hire technicians in the hope that their analyses may help encourage investors to do more in-and-out trading and thus generate commission business for the brokerage firm. Using technical analysis for market timing is especially dangerous. Because there's a long-term uptrend in the stock market, it can be very risky to be in cash. An investor who frequently carries a large cash position to avoid periods of market decline is very likely to be out of the market during some period where it rallies smartly. Professor H. Negat Sabun of the University of Michigan found that 95% of the significant market gains over the 30-year period from the mid-1960s through the mid-1990s came on 90 of the roughly 7,500 trading days. If you happen to miss those 90 days, just over 1% of the total, the generous long-run stock market returns of the period would have been wiped out. The point is that market timers risk missing the infrequent large sprints that are the big contributors to performance. The implications of this analysis are simple. If past prices contain little or no useful information for the prediction of future prices, there is no point in following any technical trading rule for the timing of purchases or sales. A simple policy of buying and holding will be at least as good as any technical procedure. Discontinue your subscriptions to worthless technical services and eschew brokers who read charts and are continually recommending trades. There's another major advantage to a buy-and-hold strategy that I have not yet mentioned. Buying and selling, to the extent that it is profitable at all, tends to generate capital gains, which are subject to tax. Buying and holding enables you to postpone or avoid gains taxes. By following any technical strategy, you are likely to realize short-term capital gains and pay larger taxes, as well as paying them sooner than you would under a buy-and-hold strategy. Thus, simply buying and holding a diversified portfolio suited to your objectives will enable you to save on investment expense, brokerage charges, and taxes, and, at the same time, to achieve an overall performance record at least as good as that obtainable using technical methods. Chapter 7. How good is fundamental analysis? John F. Kennedy said after the Bay of Pigs fiasco, "How could I have been so mistaken as to have trusted the experts?" In the beginning, he was a statistician. He wore a white starched shirt and threadbare blue suit. He quietly put on his green eye shade, sat down at his desk, and recorded meticulously the historical financial information about the companies he followed. The result? Writer's cramp. But then a metamorphosis began to set in. He rose from his desk, bought blue button-down shirts and gray flannel suits, threw away his eye shade, and began to make field trips to visit the companies that previously he had known only as a collection of financial statistics. His title now became security analyst. As time went on, his salary and perks attracted the attention of his female cohorts, and they too donned suits. And just about everybody who was anybody was now flying first class and talking money, money, money. The bright newcomers entering the job market during the 1990s laughed at the old fogey 40-year-olds and disdained their ways. The new generation was hip. Suits were out, and Gucci shoes and Armani slacks were in. They were so incredibly brilliant and knowledgeable that portfolio managers relied on their recommendations, and Wall Street firms used them increasingly to cultivate investment banking clients. They were more than security analysts. They were equity research stars. Some, however, whispered unkindly that they were investment banking whores. The views from Wall Street and academia. No matter what title, derogatory or otherwise, these individuals hold, the great majority are fundamentalists. Thus, studies casting doubt on the efficacy of technical analysis would not be considered surprising by most professionals. At heart, the Wall Street pros are fundamentalists. The really important question is whether fundamental analysis is any good. Two opposing views have been taken about the efficacy of fundamental analysis. Wall Streeters feel that fundamental analysis is becoming more powerful and skillful all the time. The individual investor has scarcely a chance against the professional portfolio manager and a team of fundamental analysts. Many in the academic community sneer at such pomposity. Some academicians have gone so far as to suggest that a blindfolded monkey throwing darts at the Wall Street Journal can select stocks with as much success as portfolio managers. They've argued that fund managers and their fundamental analysts can do no better at picking stocks than a rank amateur. My own view of the matter is not as extreme as that taken by many of my academic colleagues. Nevertheless, an understanding of the large body of research on these questions is essential for any intelligent investor. This chapter will recount the major battle in an ongoing war between academics and market professionals and why it's important to your wallet. Are security analysts fundamentally clairvoyant? Forecasting future earnings is the security analyst's raison d'etre. As institutional investor put it, earnings are the name of the game and always will be. To predict future directions, analysts generally start by looking at past wanderings. A proven score of past performance in earnings growth is, one analyst told me, a most reliable indicator of future earnings growth. If management is really skillful, there's no reason to think that it will lose its Midas touch in the future. If the same adroit management team remains at the helm, the course of future earnings growth should continue as it has in the past, or so the argument goes. While it sounds suspiciously like an argument used by technical analysts, fundamentalists pride themselves on the fact that it's based on specific, proven company performance. Such thinking flunks in the academic world. Calculations of past earnings growth are no help in predicting future growth. If you had known the growth rates of all companies during, say, the 1980 to 1990 period, this would not have helped you at all in predicting what growth they would achieve in the 1990 to 2000 period. And knowing the fast growers of the 1990s has not helped analysts find the fast growers of the early 21st century. This startling result was first reported by British researchers for companies in the United Kingdom in an article charmingly titled Higgledy-Piggledy Growth. Learned academicians at Princeton and Harvard applied the British study to U.S. companies, and, surprise, the same was true here. IBM, the cry immediately went up. Remember IBM. I do remember IBM. A steady high grower for decades. For a while, it was a glaring exception. But after the mid-1980s, even the mighty IBM failed to continue its dependable growth pattern. I also remember Polaroid, Kodak, Nortel Networks, Xerox, and dozens of other firms that chalked up consistent large growth rates until the roof fell in. I hope you remember not the current exceptions, but rather the rule. Many in Wall Street refuse to accept the fact that no reliable pattern can be discerned from past records to aid the analyst in predicting future growth. Even during the boom years of the 1990s, only 1 in 8 large companies managed to achieve consistent yearly growth, and not even 1 continued to enjoy growth into the first years of the new millennium. Analysts can't predict consistent long-run growth because it does not exist. A good analyst will argue, however, that there's much more to predicting than just examining the past record. Some will even admit that the past record is not a perfect measurement. Rather than examine every factor that goes into the actual forecasting process, John Cragg and I decided to concentrate on the end result, the prediction itself. Donning our cloak of academic detachment, we wrote to 19 of the most respected Wall Street firms engaged in fundamental analysis. We asked these firms for their estimates of the future 1-year and 5-year earnings for a large sample of S&P 500 companies. These estimates, made at several different times, were then compared with actual results to see how well the analysts forecast short-run and long-run earnings changes. The results were surprising. Bluntly stated, the careful estimates of security analysts, based on industry studies, plant visits, etc., do little better than those that would be obtained by simple extrapolation of past trends, which we have already seen are no help at all. Indeed, when compared with actual earnings growth rates, the 5-year estimates of security analysts were actually worse than the predictions from several naive forecasting models. For example, one placebo with which the analysts' estimates were compared was the assumption that every company in the economy would enjoy a growth in earnings approximating the long-run rate of growth of the national income. It often turned out that if you used this naive forecasting model, you'd make smaller errors in forecasting long-run earnings growth than by using the professional forecasts of the analysts. Our method of determining the efficacy of the security analyst diagnoses of his companies is exactly the same as was used before in evaluating the technician's medicine. We compared the results obtained by following the experts with the results from some naive mechanism involving no expertise at all. Sometimes these naive predictors work very well. For example, if you want to forecast the weather tomorrow, you'll do a pretty good job by predicting that it will be exactly the same as today. Although this system misses every one of the turning points in the weather, for most days it is quite reliable. How many weather forecasts do you suppose do any better? When confronted with the poor record of their 5-year growth estimates, the security analysts honestly, if sheepishly, admitted that 5 years ahead is really too far in advance to make reliable projections. They felt that they really ought to be judged on their ability to project earnings changes 1 year ahead. Believe it or not, it turned out that their 1-year forecasts were even worse than their 5-year projections. The analysts fought back gamely. They complained that it was unfair to judge their performance on a wide cross-section of industries because earnings for high-tech firms and various cyclical companies are notoriously hard to forecast. "Try us on utilities," one analyst confidently asserted. So we tried it, and they didn't like it. Even the forecasts for the stable utilities were far off the mark. This led to the second major finding of our study. Not one industry is easy to predict. Moreover, no analysts proved consistently superior to the others. Of course, in each year some analysts did much better than average, but no consistency in their pattern of performance was found. Analysts who did better than average 1 year were no more likely than the others to make superior forecasts in the next year. These findings have been confirmed by several other researchers. For example, Michael Sandretto of Harvard and Sudhir Krishnamurti of MIT completed a massive study of the 1-year forecasts of the 1,000 most widely followed companies. Their staggering conclusion was that the error rates each year were remarkably consistent and that the average annual error of the analysts was 31.3% over a 5-year period. Financial forecasting appears to be a science that makes astrology look respectable. Amidst all these accusations is a deadly serious message. Security analysts have enormous difficulty in performing their basic function of forecasting company earnings prospects. Investors who put blind faith in such forecasts in making their investment selections are in for some rude disappointments. Why the crystal ball is clouded. It's always somewhat disturbing to learn that a group of highly trained and well-paid professionals may not be terribly skillful at their calling. Unfortunately, this is hardly unusual. Similar types of findings could be made for most groups of professionals. There is, for example, a classic example in medicine. At a time when tonsillectomies were very fashionable, the American Child Health Association surveyed a group of 1,000 children, 11 years of age, from the public schools of New York City, and found that 611 of these had had their tonsils removed. The remaining 389 were then examined by a group of physicians, who selected 174 of these for tonsillectomies and declared that the rest had no tonsil problem. The remaining 215 were re-examined by another group of doctors, who recommended 99 of these for tonsillectomies. When the 116 healthy children were examined a third time, a similar percentage were told their tonsils had to be removed. After 3 examinations, only 65 children remained who had not been recommended for tonsillectomies. These remaining children were not examined further because the supply of examining physicians ran out. Numerous studies have shown similar results. Radiologists have failed to recognize the presence of lung disease in about 30% of the X-ray plates they read, despite the clear presence of the disease on the X-ray film. Another experiment proved that professional staffs in psychiatric hospitals could not tell the sane from the insane. The point is that we should not take for granted the reliability and accuracy of any judge, no matter how expert. When one considers the low reliability of so many kinds of judgments, it does not seem too surprising that security analysts, with their particularly difficult forecasting job, should be no exception. There are, I believe, 5 factors that help explain why security analysts have such difficulty in predicting the future. These are: 1. The influence of random events. 2. The production of dubious reported earnings through creative accounting procedures. 3. The basic incompetence of many of the analysts themselves. 4. The loss of the best analysts to the sales desk or to portfolio management. And 5. The conflicts of interest facing securities analysts at firms with large investment banking operations. Each factor deserves some discussion. 1. The influence of random events. Many of the most important changes that affect the basic prospects for corporate earnings are essentially random, that is, unpredictable. Take the utility industry, to which I referred earlier. Presumably, it's one of the most stable and dependable groups of companies. But in fact, many important, unpredictable events made earnings even for this industry enormously difficult to forecast. Throughout the late 1900s, unexpected, unfavorable rulings of state public utility commissions often made it impossible for utilities to translate rapid growth in demand into higher profits. Other unpredictable events compounded the problem. In the 1970s and early 2000s, forecasts were very wide of the mark as analysts failed to predict the increased fuel costs resulting from the sharp increase in the international price of oil. And in the 1990s, analysts failed to appreciate the extent to which deregulation and competition would reduce the profit margins of the telephone and electric utilities. Thus, even the stable utility industry has proved extraordinarily difficult to predict. Forecasting problems have been even more difficult in other industries. As we saw in Chapter 4, growth forecasts made in early 2000 for a wide variety of high-tech and telecom companies were egregiously wrong. U.S. government budgetary, contract, legal, and regulatory decisions can have enormous implications for the fortunes of individual companies. So can the incapacitation of key members of management, the discovery of a major new product, the finding of defects in a prescription drug, a major oil spill, terrorist attacks, the entry of new competitors, price wars, and natural disasters such as floods and hurricanes, among others. The stories of unpredictable events affecting earnings are endless. 2. The production of dubious reported earnings through creative accounting procedures. A firm's income statement may be likened to a bikini. What it reveals is interesting, but what it conceals is vital. Enron, one of the most ingeniously corrupt companies I have come across, led the beauty parade in this regard. Alas, Enron was far from unique. During the great bull market of the late 1990s, companies increasingly used aggressive fictions to report the soaring sales and earnings needed to propel their stocks upward. In the hit musical The Producers, Leo Bloom decides he can make more money from a flop than from a hit. He says, "It's all a matter of creative accounting." Bloom's client, Max Bialystock, sees the potential immediately. Max fleeces buckets of money from rich widows to finance a Broadway musical, Springtime for Hitler. Hoping for a total flop, he spends all the money on himself and assumes that no one will ask questions about where the money went. Actually, Bloom doesn't begin to match the tricks that have been used by companies to pump up earnings and to fool investors and security analysts alike. In Chapter 3, I described how Barry Minko's late 1980s carpet-cleaning empire, Z-Best, was built on a mosaic of phony credit card billings and fictitious contracts. But accounting abuses appear to have become even more frequent during the 1990s and early 21st century. Failing dot-coms, high-tech leaders, and even old economy blue chips all tried to hype earnings and mislead the investment community. As he left the chairmanship of the SEC in 2001, Arthur Levitt warned, "We see greater evidence of accounting illusions or tricks than has ever been true of the past." Here's but a brief number of examples of how companies have often stretched accounting rules like taffy to mislead analysts and the public as to the true state of their operations. In September 2001, Enron and Quest needed to show that their revenues and profits were still growing rapidly. They figured out a great way to make their statements look as if business was proceeding well. They swapped fiber optic network capacity at an exaggerated value of $500 million, and each company recorded the transaction as a sale. This inflated profits and masked a deteriorating position for both companies. Quest already had a surfeit of capacity, and with an enormous glut of fiber in the market, the valuation put on the trade had no justification. Motorola, Lucent, and Nortel all boosted sales and earnings by lending large amounts to their customers. Many of these accounts became uncollectible and had to be written off later. Xerox boosted its profits in the short term by allowing its overseas units in Europe and Latin America, as well as Canada, to book as one-time revenue all the cash to be paid over several years for long-term copier leases. Chainsaw Al Dunlap, the CEO of Sunbeam, needed a boost during the winter quarter to satisfy Wall Street's need for steadily growing earnings. He hit upon the ingenious idea of convincing retailers to buy backyard grills in the middle of winter. Chainsaw sweetened the deal by saying that the retailer would not have to actually pay for the grills until later, and that, furthermore, he would see to it that all purchases would be stored in Sunbeam warehouses. Eventually, he ran out of tricks, and Dunlap fled, leaving a cut-up wreck that finally went bankrupt. Eastman Kodak availed itself of big bash accounting write-offs. Kodak took 6 extraordinary charges during the 1990s, totaling $4.5 billion, equal to all the company's profits over the preceding 8 years. By charging off years of expenses at once, the company could make future earnings look that much better. It's like an individual making several years of mortgage payments in advance and then claiming that his income has grown. Then there's the pension gambit. Many companies in the late 1990s estimated that their pension plans were overfunded, and therefore they eliminated the company's contribution to the plans, thus boosting profits. Often these gains were hidden in the footnotes. When the market suffered a sharp decline during the early 2000s, the companies discovered that their plans were actually underfunded, and what investors assumed were sustainable profits turned out to be transitory. A major problem that the analyst has in interpreting current and projecting future earnings is the tendency of companies to report so-called pro forma earnings as opposed to actual earnings computed in accordance with generally accepted accounting principles. In pro forma earnings, companies decide to ignore certain costs that are considered unusual. In fact, no rules or guidelines exist. Pro forma earnings are often called earnings before all the bad stuff, and give firms license to exclude any expenses they deem to be special, extraordinary, and non-recurring. Depending on what expenses are considered to be improperly ignored, companies can report a substantial overstatement of earnings. Small wonder that security analysts have extraordinary difficulty estimating what future earnings are likely to be. Three, the basic incompetence of many of the analysts themselves. To be perfectly blunt, many security analysts are not particularly perceptive, critical, or competent. I learned this early in the game as a young Wall Street trainee. In attempting to learn the techniques of the pros, I tried to duplicate some analytic work done by a metals specialist named Louis. Louis had figured that for each 10-cent increase in the price of copper, the earnings for a particular copper producer would increase by $1 per share. Because he expected a $1 increase in the price of copper, he reasoned that this particular stock was an unusually attractive purchase candidate. In redoing the calculation, I found that Louis had misplaced a decimal point. A 10-cent increase in the price of copper would increase earnings by 10 cents, not by $1. When I pointed this out to Louis, feeling sure he would want to put out a correction immediately, he simply shrugged his shoulders and declared, "Well, the recommendation sounds more convincing if we leave the report as is." Attention to detail was clearly not the forte of this particular analyst. Louis's lack of attention to detail pointed out his lack of understanding of the industry he was covering. But he was not unique. In an article written for Barron's in early 2000, Dr. Lloyd Kreiser, a plastic surgeon, examined some reports written by biotech analysts. Kreiser paid particular attention to analysts' coverage of those biotech companies that were creating artificial skin for use in the treatment of chronic wounds and burns, a field in which he had considerable expertise. He found the security analysts' diagnoses of stocks far wide of the mark. First, he added the assumptions made of the share of the market predicted for competing companies. The predicted shares of the 5 biotech companies competing in the market for artificial skin added up to well over 100%. Moreover, the analyst's prediction of the absolute size of the potential market bore little relationship to data on the number of actual burn victims, even though accurate data were easily available. Moreover, in examining the various analyst reports on the companies, Dr. Kreiser concluded they clearly did not understand the industry. One is reminded of words attributed to the legendary baseball manager Casey Stengel. "Can't anybody here play this game?" Many analysts emulate Louis. Generally too lazy to make their own earnings projections, they prefer to copy the forecasts of other analysts or to swallow the guidance released by corporate managements without even chewing. Then it's very easy to know whom to blame if something goes wrong. And it's much easier to be wrong when your professional colleagues all agreed with you. As Keynes put it, worldly wisdom teaches that it is better for reputation to fail conventionally than to succeed unconventionally. I do not mean to imply that most Wall Street analysts do nothing more than to parrot back what managements tell them, but I do imply that the average analyst is just that, a well-paid and usually highly intelligent person who has an extraordinarily difficult job and does it in a rather mediocre fashion. Analysts are often misguided, sometimes sloppy, perhaps self-important, and at times susceptible to the same pressures as other people. In short, They are really very human beings. 4. The loss of the best analysts to the sales desk, to portfolio management, or to hedge funds. My fourth argument against the profession is a paradoxical one. Many of the best security analysts are not paid to analyze securities. They are often very high-powered institutional salespeople, or they're promoted to the prestigious position of portfolio manager. Brokerage houses that pride themselves on their research prowess project an aura of respectability by sending a security analyst to chaperone the regular salesperson on a call to a financial institution. Institutional investors like to hear about a new investment idea right from the horse's mouth, and so the regular salesperson usually sits back and lets the analyst do the talking. Thus, most of the articulate analysts find that their time is spent with institutional clients, not with financial reports. During the early 2000s, many analysts were seduced away from research to take highly compensated positions in portfolio management or with hedge funds. One of Wall Street's best-known analysts, Burton Malkiel, left Morgan Stanley in 2003 to form his own hedge fund. He writes about the attractions of his experiences in hedgehogging. It's far more exciting, prestigious, and remunerative to run money in the line position of hedge fund or portfolio manager than only to advise in the staff position of security analyst. Small wonder that many of the best-respected security analysts do not remain long in their jobs. 5. The conflicts of interest between research and investment banking departments. The analyst's goal is to wring as many cash registers as possible, and the fullest cash registers for the major brokers are to be found in the investment banking division. It wasn't always that way. In the 1970s, before the demise of fixed commissions and the introduction of discount brokerage firms, the retail brokerage operation paid the tab and analysts could feel they were really working for their customers, the retail and institutional investors. But that profit center faded in importance with competitive commissions, and the only gold mine left was the underwriting of new issues for new or existing firms, where fees can run to hundreds of millions of dollars, and advising firms on borrowing facilities, restructuring, acquisitions, etc. And so it came to pass that ringing the cash registers meant helping the brokerage firm obtain and nurture banking clients. And that's how the conflicts arose. Analysts' salaries and bonuses were determined in part by their role in assisting the underwriting department. When such business relationships existed, critics assert, the analyst became nothing more than a tool of the investment banking division. One indication of the tight relationship between security analysts and their investment banking operations has been the traditional paucity of sell recommendations. There has always been some bias in the ratio of buy-to-sell recommendations, since analysts do not want to offend the companies they cover. But as investment banking revenues became the major source of profits for the major brokerage firms, research analysts were increasingly paid to be bullish rather than accurate. In one celebrated incident, an analyst who had the chutzpah to recommend that Trump's Taj Mahal bonds should be sold because they were unlikely to pay their interest was summarily fired by his firm after threats of legal retaliation from the Donald himself. Later, the bonds did default. This is far from an isolated incident. An analyst from BNP Paribas alleged that he was forced out of his job after a sell recommendation on Enron. Small wonder that most analysts have purged their prose of negative comments that might give offense to current or prospective investment banking clients. In the 1990s, the ratio of buy-to-sell recommendations climbed to 100 to 1, particularly for brokerage firms with large investment banking businesses. To be sure, when an analyst says buy, he may mean hold, and when he says hold, he probably means this as a euphemism for dump this piece of crap as soon as possible. But investors should not need a course in deconstruction semantics to understand the recommendations, and most individual investors sadly took the analysts at their words during the Internet bubble. There is convincing evidence that analyst recommendations are tainted by the very profitable investment banking relationships of the brokerage firms. Several studies have assessed the accuracy of analysts' stock selections. Brad Barber of the University of California studied the performance of the strong buy recommendations of Wall Street analysts and found it nothing short of disastrous. Indeed, the analysts' strong buy recommendations underperformed the market as a whole by 3% per month, while their sell recommendations outperformed the markets by 3.8% per month. Even worse, researchers at Dartmouth and Cornell found that stock recommendations of Wall Street firms without investment banking relationships did much better than the recommendations of brokerage firms that were involved in profitable investment banking relationships with the companies they covered. A study from Investors.com found that investors lost over 50% when they followed the advice of an analyst employed by a Wall Street firm that managed or co-managed the initial public offering of the recommended stock. Research analysts were basically paid to tout the stocks of the firm's underwriting clients, and analysts lick the hands that feed them. In 2002, the Attorney General of the state of New York, Eliot Spitzer, found a smoking gun. While Henry Blodgett and other analysts at Merrill Lynch were officially recommending a number of Internet and new economy stocks, the same analysts were referring to the stocks disparagingly in email messages as junk, dogs, or less attractive epithets. Merrill did not admit guilt, but it settled with New York and other states for $100 million. Merrill also promised certain reforms, such as not directly tying analysts' pay to investment banking revenues, clarifying its stock recommendations, and better disclosing potential conflicts of interest. Other firms, such as Goldman Sachs and Smith Barney, quickly embraced the Merrill proposals. The situation today is somewhat improved. Outright sell recommendations have become more common, although the bias to buy advice remains. But the Sarbanes-Oxley legislation, which followed the scandals associated with the Internet bubble, made the job of the analyst more difficult by limiting the extent to which corporate financial officers could talk to Wall Street analysts. The SEC has promulgated a policy of fair disclosure, whereby any relevant company information must be made public immediately and thus disclosed to the whole market. While such a policy can help make the stock market even more efficient, many disgruntled security analysts dub the situation as one of no disclosure. Security analysts could no longer have early access to privileged information. Thus, there is no reason to believe that the recommendations of security analysts will improve in the future. Do security analysts pick winners? The performance of the mutual funds. I can almost hear the chorus in the background as I write these words. It goes something like this. The real test of the analyst lies in the performance of the stocks he recommends. Maybe Sloppy Louie, the copper analyst, did mess up his earnings forecast with a misplaced decimal point. But if the stocks he recommended made money for his clients, his lack of attention to detail can surely be forgiven. Analyze investment performance, the chorus is saying, not earnings forecasts. Fortunately, the records of one group of professionals, the mutual funds, are publicly available. Better still for my argument, many of the men and women at the funds are the best analysts and portfolio managers in the business. By their own admission, they can clearly make above-average returns. As one investment manager recently put it will take many years before the general level of competence rises enough to overshadow the startling advantage of today's aggressive investment manager. Statements like these were just too tempting to the lofty-minded in the academic world. Given the wealth of available data, the time available to conduct such research, and the overwhelming desire to prove academic superiority in such matters, it was only natural that academia would zero in on mutual fund performance. Again, the evidence from several studies is remarkably uniform. Investors have done no better with the average mutual fund than they could have done by purchasing and holding an unmanaged broad stock index. In other words, over long periods of time, mutual fund portfolios have not outperformed randomly selected groups of stocks. Although funds may have very good records for certain short periods of time, there is generally no consistency to superior performance, and there is no way to predict in advance how funds will perform in any given future period. In addition to the scientific evidence that has been accumulated, several less formal tests have verified this finding. For example, in the early 1990s, the Wall Street Journal started a dartboard contest in which each month the selections of 4 experts were pitted against the selections of 4 darts. The Journal kindly let me throw the darts for the first contest. By the early 2000s, the experts appeared to be somewhat ahead of the darts. If, however, the performance of the experts was measured from the day their selections and their attendant publicity was announced in the Journal, rather than from the preceding day, the darts were actually slightly ahead. Does this mean that the wrist is mightier than the brain? Perhaps not, but I think Forbes magazine raised a very valid question when one journalist concluded, "It would seem that a combination of luck and sloth beats brains." How can this be? Every year, one can read the performance rankings of mutual funds. These always show many funds beating the averages, some by significant amounts. The problem is that there's no consistency to performance. Just as past earnings growth cannot predict future earnings, neither can past performance predict future results. Fund managements are also subject to random events. They may grow fat, become lazy, or break up. An investment approach that works very well for one period can easily turn sour the next. One is tempted to conclude that a very important factor in determining performance ranking is our old friend, Lady Luck. This conclusion is not a recent one. It is held throughout the past 40 years, a period of great change in the market and in the percentage of the general public holding stocks. Again and again, yesterday's star fund has proven to be today's disaster. During the late 1960s, the go-go funds with their youthful gunslingers turned in spectacular results, and their fund managers were written up like sports celebrities. But when the next bear market hit from 1969 through 1976, it was fly now, pay later. The top funds of 1968 had a perfectly disastrous subsequent performance. The Mates Fund, for example, was number 1 in 1968. At the end of 1974, the fund had lost 93% of its 1968 value, and Fred Mates finally threw in the towel. He left the investment community to start a singles bar in New York City, appropriately named Mates. Indeed, most of the top-performing funds of the late 1960s were out of business by the mid-1970s. The illustration from the late 1960s appeared in the first edition of this book. Similar results continue to hold. Many of the top funds of the 1970s ranked close to the bottom during the 1980s. Although the top 20 funds almost doubled the average fund return during the 1970s, 19.0% versus 10.4%, those same funds did worse than average, 11.1% versus 11.7%, over the next decade. There was, however, one striking exception. The Magellan Fund, managed by Peter Lynch, was a superior performer in both the 1970s and 1980s, but Lynch retired in 1990 at the ripe old age of 46, and we'll never know if he would have continued to beat the street. An even more dramatic example looks at the best-performing general equity funds during the 1994 to 1999 period. We find that the 20 hottest funds earned rates of return during the last 6 years of the 1990s that were on average over 30%, well above the return for the market. These were the genius fund managers interviewed adoringly on CNBC and featured in articles in investment magazines. In fact, these funds had simply loaded up their portfolios with new economy stocks. They'd ridden the internet bubble up, but when the bubble burst, they collapsed as well. On average, during the first 6 years of the 2000s, these funds performed far worse than the market as a whole. Investors learned that making 100% one year and losing 50% the next left them exactly where they started out. On the whole, investors suffered punishing losses in these funds during the early 2000s. In any activity in which large numbers of people are engaged, although the average is likely to predominate, the unexpected is bound to happen. The very small number of really good performers we find in the investment management business actually is not at all inconsistent with the laws of chance. Indeed, as I mentioned earlier, the fact that good past performance of a mutual fund is generally no help in predicting future performance only serves to emphasize this point. Perhaps the laws of chance should be illustrated. Let's engage in a coin-flipping contest. Those who can consistently flip heads will be declared winners. The contest begins, and 1,000 contestants flip coins. Just as would be expected by chance, 500 of them flip heads, and these winners are allowed to advance to the second stage of the contest and flip again. As might be expected, 250 flip heads. Operating under the laws of chance, there will be 125 winners in the third round, 63 in the fourth, 31 in the fifth, 16 in the sixth, and 8 in the seventh. By this time, crowds start to gather to witness the surprising ability of these expert coin flippers. The winners are overwhelmed with adulation. They're celebrated as geniuses in the art of coin flipping. Their biographies are written, and people urgently seek their advice. After all, there were 1,000 contestants, and only 8 could consistently flip heads. The game continues, and some contestants eventually flip heads 9 and 10 times in a row. If we had let the losers continue to play, as mutual fund managers do, even after a bad year, we would have found several more contestants who flipped 8 or 9 heads out of 10 and were therefore regarded as expert coin flippers. The point of this analogy is not to indicate that investment fund managers can or should make their decisions by flipping coins, but that the laws of chance do operate and that they can explain some amazing success stories. It is the nature of an average that some investors will beat it. With large numbers of players in the money game, chance will, and does, explain some extraordinary performances. The very great publicity given occasional success in stock selection reminds me of the story of the doctor who claimed he had developed a cure for cancer in chickens. He proudly announced that in 33% of the cases tested, remarkable improvement was noted. In another 1/3 of the cases, he admitted there seemed to be no change in condition. He then rather sheepishly added, "And I'm afraid the third chicken ran away." Although the preceding discussion has focused on mutual funds, it should not be assumed that the funds are simply the worst of the whole lot of investment managers. In fact, the mutual funds have had a somewhat better performance record than many other professional investors. The records of life insurance companies, property and casualty insurance companies, pension funds, foundations, state and local trust funds, personal trusts administered by banks, and individual discretionary accounts handled by investment advisors have all been studied. No sizable difference in the investment performance of common stock portfolios exist among these professional investors or between these groups and the market as a whole. As in the case of the mutual funds, there are some exceptions, but again they are very rare. No scientific evidence has yet been assembled to indicate that the investment performance of professionally managed portfolios as a group has been any better than that of a broad-based index. Can any fundamental system pick winners? Research has also been done on whether above-average returns can be earned by using trading systems based on press announcements of new fundamental information. The answer seems to be a clear no. Systems have been devised in which a news event, such as the announcement of an unexpectedly large increase in earnings or a stock split, triggers a buy signal. But the evidence points mainly toward the efficiency of the market in adjusting so rapidly to new information that it's impossible to devise successful trading strategies on the basis of such news announcements. These tests are often referred to as tests of the semi-strong form of the efficient market hypothesis. As mentioned earlier, the weak form asserts that past price information cannot be exploited to develop successful trading strategies. The semi-strong form says that no publicly announced news event can be exploited by investors to obtain above-average returns. Research indicates that on average, stock prices react well in advance of unexpectedly good or unexpectedly bad earnings reports. In other words, the market is usually sufficiently efficient at anticipating published earnings announcements that investment strategies involving purchases or sales of stocks after the publication of those announcements do not appear to offer any help to the general investor. Although it is true that some studies have found that stock prices sometimes underreact to earnings announcements, whatever abnormalities exist do not occur consistently over time. Indeed, stock prices overreact to earnings news about as often as they underreact. Similarly, no new information is obtained from announcements of stock splits. Although it's true that companies splitting their stocks have generally enjoyed rising stock prices in the period before the announcement, the relative performance of the stocks after the announcement turns out to be in line with that of the general market. These studies lend support to the old Wall Street maxim, "A pie doesn't grow through its slicing." A good deal of research has also been done on the usefulness of dividend increases as a basis for selecting stocks that will give above-average performance. The argument is that an increase in a stock's dividend is a signal by management that it anticipates strong future earnings. Dividend increases, in fact, are usually an accurate indicator of increases in future earnings. There's also some tendency for a strong price performance to follow the dividend announcement. However, any rise in price resulting from the dividend increase, although perhaps not immediately reflected in the price of the stock, is reflected reasonably completely by the end of the announcement month. The verdict on market timing. Many professional investors move money from cash to equities or to long-term bonds on the basis of their forecasts of fundamental economic conditions. Indeed, this is one reason many brokers give to support their belief in professional money management. The words of John Bogle, founder of the Vanguard Group of investment companies, are closest to my views on the subject of market timing. Bogle said, "In 30 years in this business, I do not know anybody who has done it successfully and consistently, nor anybody who knows anybody who has done it successfully and consistently. Indeed, my impression is that trying to do market timing is likely not only not to add value to your investment program, but to be counterproductive." Bogle's point may be very well illustrated by an examination of how mutual funds have varied their cash positions in response to their changing views about the relative attractiveness of equities. Mutual fund managers have been incorrect in their allocation of assets into cash in essentially every recent market cycle. Caution on the part of mutual fund managers, as represented by a very high cash allocation, coincides almost perfectly with troughs in the stock market. Peaks in mutual funds' cash positions have coincided with market troughs during 1970, 1974, 1982, and at the end of 1987, after the great stock market crash. Another peak in cash positions occurred in late 1990, just before the market rally during 1991 and in 1994, just before the greatest six-year rise in stock prices in market history. Cash positions were also high in late 2002, at the trough of the market. Conversely, the allocation to cash of mutual fund managers was almost invariably at a low during peak periods in the market. For example, the cash position of mutual funds was near an all-time low in March 2000, just before the market began its sharp decline. Clearly, the ability of mutual fund managers to time the market has been egregiously poor. Over the past 54 years, the market has risen in 36 years, been even in 3 years, and declined in only 15. Thus, the odds of being successful when you are in cash rather than stocks is almost 3 to 1 against you. An academic study by Professors Richard Woodward and Jess Chua of the University of Calgary shows that holding onto your stocks as long-term investments works better than market timing because your gains from being in stocks during bull markets far outweigh the losses in bear markets. The professors conclude that a market timer would have to make correct decisions 70% of the time to outperform a buy and hold investor. I've never met anyone who can bat 700 in calling market turns. The semi-strong and strong forms of the efficient market theory. The academic community has rendered its judgment. Fundamental analysis is no better than technical analysis in enabling investors to capture above-average returns. Nevertheless, given its propensity for splitting hairs, the academic community soon fell to quarreling over the precise definition of fundamental information. Some said it was what is known now. Others said it extended to the hereafter. It was at this point that what began as the strong form of the efficient market theory split into two. As we have seen, the semi-strong form says that no public information will help the analyst select undervalued securities. The argument here is that the structure of market prices already takes into account any public information that may be contained in balance sheets, income statements, dividends, and so forth. Professional analyses of these data will be useless. The strong form says that absolutely nothing that is known or even knowable about a company will benefit the fundamental analyst. Not only all the news that is public, but also all the information that is possible to know about the company has already been reflected in the price of the stock. According to the strong form of the theory, not even inside information can help the investors. The strong form of the theory is obviously an overstatement if it does not admit the possibility of gaining from inside information. Nathan Rothschild made millions in the market when his carrier pigeons brought him the first news of Wellington's victory at Waterloo before other traders were aware of the victory. But today the information superhighway carries news far more swiftly than carrier pigeons, and Regulation FD, meaning fair disclosure, requires companies to make prompt public announcements of any material news items that may affect the price of their stock. Moreover, insiders who do profit from trading on the basis of non-public information are breaking the law. The Nobel laureate Paul Samuelson sums up the situation as follows. If intelligent people are constantly shopping around for good value, selling those stocks they think will turn out to be overvalued, and buying those they expect are now undervalued, the result of this action by intelligent investors will be to have existing stock prices already have discounted in them an allowance for their future prospects. Hence, to the passive investor who does not himself search for under- and overvalued situations, there will be presented a pattern of stock prices that makes one stock about as good or bad a buy as another. To that passive investor, chance alone would be as good a method of selection as anything else. This is a statement of the efficient market theory. The narrow or weak form of the theory says that technical analysis, looking at past stock prices, could not help investors. Prices move from period to period very much like a random walk. The broad, semi-strong, and strong forms state that fundamental analysis is not helpful either. All that is known concerning the expected growth of the company's earnings and dividends, all the possible favorable and unfavorable developments affecting the company that might be studied by the fundamental analyst, is already reflected in the price of the company's stock. Thus, purchasing a fund holding all the stocks in a broad-based index will produce a portfolio that can be expected to do as well as any managed by professional security analysts. The efficient market theory does not, as some critics have proclaimed, state that stock prices move aimlessly and erratically, and are insensitive to changes in fundamental information. On the contrary, the reason prices move in a random walk is just the opposite. The market is so efficient, prices move so quickly when information arises, that no one can buy or sell fast enough to benefit. And real news develops randomly, that is, unpredictably. It cannot be predicted by studying either past technical or fundamental information. Even the legendary Benjamin Graham, heralded as the father of fundamental security analysis, reluctantly came to the conclusion that fundamental security analysis could no longer be counted on to produce superior investment returns. Shortly before he died in 1976, he was quoted in an interview in the Financial Analyst's Journal as saying, "I am no longer an advocate of elaborate techniques of security analysis in order to find superior value opportunities." This was a rewarding activity, say 40 years ago, when Graham and Dodd was first published, but the situation has changed. Today, I doubt whether such extensive efforts will generate sufficiently superior selections to justify their cost. I'm on the side of the efficient market school of thought. And Peter Lynch, just after he retired from managing the Magellan Fund, as well as the legendary Warren Buffett, admitted that most investors would be better off in an index fund rather than investing in an actively managed equity mutual fund.
This ends